Okay, all right. So, good morning, everyone. Today is our fifth session on consolidation, and we are in a position to now move further with our adjustments. One second, just a minute, some technical issue. Just a minute, please. Okay. All right, I think now should this work? Yep. Okay. So in our previous session, we were discussing elimination of intercompany transactions. We were discussing elimination of intercompany transactions. So what do you mean by intercompany transactions? Well, transactions such as sale of goods between the parent and the subsidiary that creates balances of debtors and creditors between the parent and subsidiary, or bills receivable, bills payable, or alternatively intercompany loans and advances that are given, which will require an elimination. See, ideally they appear in the standalone balances, in the standalone financials as intercorporate balances. But when I do the consolidation, the issue is I cannot keep these balances as appearing in the consolidated balance sheet. That is because parent and subsidiary, the consolidated statements, appear as one single financial statement, the financial statement of one single entity. And therefore, whatever intercorporate balances are there, I will have to eliminate them. So we studied the first two intercompany eliminations, that is the first one being debtors and the other one being intercompany loans and advances. In loans and advances, we saw that it is possible that sometimes interest adjustments may not be done. It is necessary to do this adjustment. See, we will probably think that it is income for one company and expense for the other company. So why do we need to do it? You need to do it because it is possible that your subsidiary, you may not have invested entirely. There may be a non-controlling interest. So if I do not record these interest on loans correctly, my non-controlling interest balances will appear incorrectly in the consolidated financial statements, and that is why it becomes necessary to record them. Okay, so with this background, we had done the first two adjustments. Just a recap of what we have done. The third one is a little more important. Okay, continuation of same note number 7, I think, of our consolidation adjustments. We are having intercompany debentures, or what we call as preference shares. Is it necessary to only give a loan? Not at all. You can also invest in intercompany debentures. So when I talk about intercompany debentures or intercompany preference shares, there is one underlying thing that we have to know, which is that these debentures or preference shares are basically instruments which are tradable in the market. Okay, so the important point is these instruments, you can note this down, are tradable securities, in the market, and the purchaser would have recorded them at the market price, which could be quite different from what is recorded by the issuer. What is recorded by the issuer. Okay. So if that is the case, how do I do the elimination? See, suppose the parent has purchased intercompany debentures. Suppose the parent is acquiring intercompany debentures of its subsidiary from the market. These debentures are having, say, a face value of 1,000 rupees, but they are traded in the market for, say, 1,050 rupees. So the face value is 1,000. So the subsidiary would have recorded a liability at 1,000, but the parent would have recorded an investment of 1,050 rupees in those debentures. So now the question is, do they represent intercompany balances? Definitely they do. It is the investment of one which is the liability of the other. And if that is the case, should I eliminate them? Technically speaking, yes. But when I proceed to eliminate them, I will be left with a 50 rupees difference because I paid more. So it is as if you can imagine that a liability of 1,000 is being settled by a payment of 1,050. So this extra 50 rupees is what will be taken to the consolidated profit and loss, because it represents notional loss on settlement. Standalone, you will not touch anything. But in your consolidation, if you opt for settlement, then at that point of time, you can do this adjustment and take the difference to your consolidated profit and loss. However, it is possible that sometimes these preference shares or debentures could be irredeemable preference shares or irredeemable debentures with discretionary interest or discretionary dividends. Means for all practical purposes under financial instruments chapter, these are going to be classified as equity. Okay. If these are going to be classified as equity, then where would equity items go? Look at our format. We start with schedule 3 balance sheet. Then below that we are having note number 1, all assets and liabilities. Will I have assets and liabilities appearing here? Answer is no, because this is a part of equity. Then I have note number 2, that is equity share capital. Note number 3, that is consolidated other equity. Working note 1 is working for reserves. Working note 2, I prepare the cost of control account. And in the cost of control account, what you would be having is, in the COC account, you would be having, on the debit side, you write off the investment. On the credit side, you typically adjust the equity share capital. You adjust the pre-acquisition reserves. These instruments which are classified as equity will automatically be adjusted in the COC account, as well as whatever balance is there with the NCI. And once that is done, I will proceed to balance the COC account as well as the NCI, and ultimately the difference gets adjusted in goodwill. Okay, so these could be quite different from what is recorded. So sir, what do we take it? Do we take it as equity when doing the question? Do we take it as a liability when doing the question? Answer is nothing is given. We do not make our lives complicated. We will take them as financial liability and do the adjustment. Only if the question specifies that these are in the nature of equity, or gives information that gives the conclusion that they are in the nature of equity, only and only under those circumstances we will be taking it as equity and doing the elimination. Okay, so we will be having two treatments for this. The first one is classified as financial liability. Assumed as such unless otherwise specified. Unless otherwise specified. If this is the case, it is a liability. Where do my liabilities go? Sir, my liabilities go in note number 1. So I will be recording parents' investment in debentures, and I will also be recording in the subsidiary column the liability for those debentures. So ultimately the difference, whatever is there, it will go in the consolidated P&L. Okay. So eliminated through note 1. Through note 1 with the difference, if any, taken to, where will I take? Sir, we'll take it to the consolidated P&L. We'll take it to the consolidated P&L. Is it okay? So what will be the journal entry for this? In the consolidated books, the journal entry is going to be debentures / preference shares debit, whatever be the amount, to investment in debentures / preference shares debit, sorry, to investment credit, and whatever difference is there, we will be taking it to consolidated P&L. We will be taking it to consolidated P&L. If it is a gain where the investments are traded below the face value, then that will result in a credit to the consolidated P&L. Okay. So this is what is your adjustment. Okay. This is what is your adjustment if it is classified as a financial liability. Alternatively, what will happen is it could be classified as equity as per Ind AS 109. You will do it only if specifically given in the question. Otherwise, please assume it as a financial liability. If it is regarded as equity, eliminate through COC account, that is working note 2, and NCI account, that is working note 3. Difference between investment and intercompany liability / capital is adjusted as under. This adjustment would happen as under. Okay, what would happen is COC account, difference adjusted in goodwill. Difference adjusted in goodwill attributable to the parent. If I talk about NCI account, I again have two options. If I talk about NCI account, I will again have two options. First one is NCI at fair value. NCI at fair value. If this is the case, closing balance depends on the market price of the subsidiary shares, and therefore closing balance will not change. What will change is difference would be adjusted in the goodwill attributable to the NCI. Difference adjusted automatically, it is a balancing figure. Okay, adjusted in goodwill attributable to NCI. If NCI at proportionate share of net assets, if that is the case, then closing balance of NCI would be adjusted for the difference. Would be adjusted for the difference. Okay, so this is what is your treatment in case it is classified as equity. In case it is classified as equity. Okay, if it is classified as equity. Okay, so Shivashankari has asked, could you please share the answer of question number 47? Okay, question number 47 was the last session's question that we did. If you don't mind, can I take it later on, Shivashankari? I'll share it, not a problem, but could I share it a little later? Okay. Any specific doubt in that, please let me know. Okay, any specific doubt, please let me know. Why is it allocated to COC? Because in this case, Sheena Jain, the instrument is classified as equity. The instrument is classified as equity. If it is equity, it means you have invested in the equity in an instrument which is recorded as equity in the subsidiary. I won't say you have invested directly in equity instruments, because that is equity share capital. In this case, you have invested in preference shares or debentures, which are nothing but in the nature of equity. That is why this investment cannot go as a financial liability adjustment in note number 1. It is intercompany balance, yes, but it is not a asset liability relationship. It is an equity relationship, and therefore we are going to take it to the COC account, and the adjustment also will happen in the COC account, where, like how you eliminate equity share capital, preference share capital, similarly you will also adjust these debentures or preference shares which are classified as equity. Okay, which are classified as equity. Okay, so equity and NCI both. Okay, so this takes care of the adjustment relating to intercompany eliminations. Okay, so Sheena Jain, please confirm if you have understood that part. Yes, please confirm. We will be doing a question right now. I had told you to go through question number 46. We'll be doing that, but before that, I just have an example for this part, that is instruments classified as equity. Okay. If instruments are classified as liability, we have a question which I'm going to solve. So that I'll be doing. But right now, we will just have an example. If you can note this down here itself in the theory section. If instruments classified as equity, if instruments classified as equity. Okay, if instruments classified as equity, books of parent, investment in preference shares of subsidiary. How much? 500 shares at rupees 120. At rupees 120. This is the value which is traded in the market. Okay. So 500 into 120, that comes to, if I'm not wrong, it comes to 60,000 rupees. Books of S, preference share capital, preference share capital This is classified as equity. This is classified as equity. I'm not saying equity shares, I'm saying equity instruments. Okay. So this is going to be 500 shares. No, you will be able to recover, Sheena. I don't think it will affect. Okay, don't worry. Okay, 500 shares at rupees 100. This is the face value. So this is rupees 50,000. This is rupees 50,000. Okay. So this takes care of the preference shares as well as the investment in preference shares. Okay. So now when I do the consolidation, as long as you have attended the initial consolidation sessions, Sheena, where you know the basics, I think you are in a position to understand this. Okay. You are in a position to understand this. Anyways, whatever I have done in the last session, I will try to repeat wherever it is required. Okay. So should not be a problem. So solution, it is an equity, in instrument in the nature of equity. So no effect in note 1. What is note 1? Sir, note 1 deals with assets and liabilities, recorded and consolidation adjustment. This won't go there because this is neither an asset nor a liability. Okay. And then the other one is working note 1. What is working note 1? Consolidated P&L. Workings. This won't go there because ultimately it is going to COC. COC balances never go to consolidated P&L. Likewise, NCI balances is taken to the balance sheet. It does not go in the consolidated P&L. So no adjustment in note 1/working note 1. Okay. However, the effect will happen in the COC account. So I hope you have written that, what I wrote just now. The effect will happen in cost of control account. What are the changes? Well, your normal cost of control account looks something like this. To investment in equity shares. I eliminate this the first place, if you remember. Then I also eliminate by equity share capital whatever is the portion attributable to the parent. I also eliminate by pre-acquisition reserves. This typically comes from working note 4 if you are able to recollect. Then I have made investment in preference shares. So it is in the nature of equity. So that will get eliminated here. To investment in preference shares. This is in the nature of equity. Nature of equity. And on the credit side, by preference share capital. By preference share capital. Sir, how much is it going to be? It is going to be, in our question, kitna tha wo? Yes, 50,000 rupees. It is going to be 50,000 rupees. Okay. In our question, this was, if I'm not mistaken, 60,000. So ultimately, when I sit to balance this, account, I get goodwill, say, as a balancing figure. When I get goodwill, what is going to happen to this goodwill? 60 minus 50. The excess amount which I have invested, that excess amount is going to ultimately be reflected in goodwill. So by goodwill increased by 10,000. Increased by 10,000 automatically. Increased by 10,000 automatically. Okay. Increased by this automatically. Okay. And ultimately, you may not be holding the entire preference share capital. You hold a small percentage. So whatever you are not holding, that will go in NCI account. That will go in NCI account. Okay. Theory. So in your NCI account, typically I have by equity share capital, by pre-acquisition reserves, and by preference share capital. It could be debentures also, if debentures are in the nature of equity. Okay, whatever it is. So if I am following partial goodwill, my balance carried down is the balancing figure. This gets affected. This gets affected, impacted. If my NCI is at fair value, this figure would be fixed. But what will happen is the goodwill attributable would be taken. The goodwill attributable would be to the NCI would be affected. That excess of 10,000 would actually be received by a market participant. You purchase from the market, right? So it would be received by any market participant. Okay, so that's about it. It won't be received by the subsidiary, because once the shares are traded or the securities are traded in the market, it is going to be received by any other market participant. Okay, any other market participant. Is it okay? So this is what is the adjustment. NCI, this is proportionate share of net assets. Proportionate share of net assets. If you are following NCI at fair value, the goodwill starts to get affected. Okay. Goodwill starts to get impacted. Okay. So just take a note of this. These two accounts, you can just draw the pro forma and keep it ready. Draw the pro forma and keep it ready. Okay, so with this background, I had told you guys to read a question. Shairam, who else were there in the last class? Shiva Shankari, not able to recollect. I think Kumar Mangalam was there. Okay, so I told you to read a question. We will check this question now. Okay, we'll be doing it. The balance sheets of Aqua Limited and Baka Limited as on the dates of last closing of accounts are as under. So Aqua Limited's closing is as on 31st March 20x7. Baka Limited is as on 31st December 20x6. So can I say that these are different reporting dates? Can I say that these are different reporting dates? Yes. If these are different reporting dates, what do we need to do? We need to check if the difference is up to 3 months or greater than 3 months. If it is up to 3 months, we will have to prepare financial statements of the subsidiary, adjusting it only for material events. What do you mean by material events? What are prescribed by the management? Those are known as material events. However, if the difference exceeds a period of 3 months, then at that point of time, you will be treating it as what will you treat it as? You will be treating it as a full adjustment that is needed to the subsidiary's balance sheet. So let us look at this problem. You have share capital, accumulated profits and reserves, 15% non-convertible debentures, accounts payable, other liabilities. On the asset side, you have fixed assets less depreciation, investment 40,000 shares in Baka and 1,000 debentures in Baka. Current assets, you have inventories, accounts receivable, cash and bank. Okay. The following information is also made available. On 8th February 20x7, that is after the balance sheet date of Aqua, that is after the balance sheet date of Baka, after the balance sheet date of Baka, but before the balance sheet date of Aqua. Okay, so Aqua is the parent, Baka is the subsidiary. So Baka's financials have to be restated for material items. Baka's balance sheet has to be restated for material items. This event is happening after Baka's balance sheet, which is given to you. It is a material event, that is why they have given to you, and therefore on 8th February 20x7, there was a fire resulting in inventory worth 20,000 being destroyed. Okay, Baka received 75% of the loss as insurance. So as a result, remaining 25% is a loss that would be adjusted against the reserves of the company. Okay, all right, accumulated profits and reserves. On 13th March 20x7, Aqua, that is the parent, sold goods costing 1,50,000 to Baka, that is the subsidiary. So parent is selling to the subsidiary. So this becomes what we call a downstream transactions. From top, the transaction is flowing downwards. So this becomes a downstream transaction at a markup of 20%. Markup means cost plus profit margin. Cost plus profit margin. Whereas if it is sold at a margin of 20%, it means 20% on selling price. Okay. Half of these goods were resold to Aqua. So parent sold some goods to Baka. Usme se aadhe goods Baka sold back to the parent, and who in turn, that is the parent, was able to liquidate the entire inventory before closure of accounts on 31st March 20x7. Okay, this should be 20x7. Okay, so parent sold goods to the subsidiary. There will be intercompany profits. Out of those goods, half of the goods have been sold back to the parent from the subsidiary, and ultimately these goods are sold in the outside market. So there is no adjustment required for elimination in respect of these goods which were sold by subsidiary to parent, which were subsequently sold in the outside market, because these now become realized profits. Okay, as on 31st March 20x7, Baka's accounts payable shows 60,000 due to Aqua on the two transactions. Okay, so we'll have a check what is there. Aqua also acquired Aqua acquired the holdings in Baka on 1st January 20x5, when the reserves and accumulated profits of Baka stood at 75,000. Okay. Requested to prepare the consolidated accounts of the two companies and a consolidated balance sheet of Aqua Limited as at 31st March 20x7. Okay, 20x7. All right. So now let us start this question. Can I directly proceed with this question? Answer is no. I will have to restate this balance sheet. So first step is restate this balance sheet. Why? Subsidiary, different reporting date, up to 3 months, material events will be adjusted. So what are my material events? The first one is the fire destroying certain inventory. Consequent to that, getting an insurance also. So these two are material events which I can see. Then you are also having this post the date on 31st December, you are having transactions. Between the parent and the subsidiary. So that becomes a material transaction. Rest all, nothing is material. Okay, so don't sit saying sales kitna hua, purchase kitna hua, wages kitna hua, what are my expenses, what is the depreciation, all those things we are not concerned with at the moment. Okay, only the material events, which are two. That is, one is fire and the second is intercompany sale that is happening. Okay, so with that background, let us come to question number 46. This is not there in your revised study material. It is there in your old syllabus. Okay, so this too, why it came, I don't know. Okay, so equity and liabilities and assets. So we start up with the question. First thing, take the equity share capital 5 lakhs. Okay, take the equity share capital as 5 lakhs. Here you don't need schedule 3 format because this is just a rough working. Okay, so share capital 5 lakhs. Okay, next one is accumulated profits and reserves 2 lakh 5,000. Okay, will this be adjusted? Yes. So accumulated profits and reserves. Okay, so it all started with 2 lakh 5,000. It all started with 2 lakh 5,000 and there was a fire. The fire gutted out inventory, but you got 75%. So ultimately you had a 5,000 rupees loss. So minus 5,000. Minus 5,000. Okay, next one is there was an intercompany sale that has happened from Baka to Aqua. There was an intercompany sale that happened from Baka to Aqua. Because that has happened, is it a material transaction? Yes, they have given to you, and therefore we will have to prepare a working for that. We will have to prepare a working for that. So in all, two workings will come. First one is loss by fire. So here the entry is going to be bank account debit. The insurance claim is received 15,000 to inventory. This went down by 20,000. So here I am having how much? 5,000. This is loss by fire. Where does it go? Accumulated profits. Accumulated profits. Okay. So this is your first working note. And we have given one effect, that is this effect is given. These two effects are still pending. Let us give those effects and then proceed further. Okay. So in your asset side, you have property, plant and equipment appearing at 4,05,000. Don't worry, 3 साल का depreciation नहीं, 3 महीने का depreciation नहीं है. It's not given, it's not material. So that is the attitude we need to have for this question. Okay. Net of depreciation. Next one is I have inventory. Okay. So inventory, we have an adjustment. You can leave about 2-3 lines and write down below that trade receivables. Trade receivables. No adjustment to this. So this would directly come at 2,65,000. 2,65,000. And finally, you are having cash bank. So this comes to how much? 3,05,000 is the opening balance. Yes, 3,05,000. After this 31st December, you have received 75% as insurance. Okay, so in our working also 15,000 has come. Okay, so you can come to bank plus 15,000. So this gives you 3,20,000. 3,20,000. Okay. So that takes care of this part. We then move on to the next adjustment. On 13th March 20x7, Aqua sold goods costing 1,50,000 to Baka at a markup of 20%. Okay, so intercompany goods are being sold. So cost price to Aqua is 1,50,000. Add markup at the rate of 20%. So this gives you 30,000. So 1,80,000. What does it become? This becomes selling price of which company? The parent company, Aqua. This becomes the selling price of the parent company, Aqua. Is it okay? Have you understood? Right? Therefore, profits Aqua is 30,000. What is happening is, now just pay attention. Aqua and Baka. So Aqua sells these goods to Baka at this price. So this becomes a downstream transaction. This becomes a downstream transaction with cost to Baka. Cost price to Baka going to be 1,80,000. 1,80,000. Out of 1,80,000, what they have told, half of these goods were resold to Aqua, who in turn was able to liquidate it by selling to outsiders before 31st March. So the return sale has also happened before 31st of March. So less COGS. How much is that? 1,80,000 into 50%. So that gives you 90,000. So when I reduce, this 90,000 is going to be my cost of unsold goods. Cost of unsold goods. Is it okay? Yes. And it is these goods which are ultimately sold back to the parent. Okay. Now, for these sales, cost price to Baka is worth 90,000. Cost price is worth 90,000. What I need is selling price of Baka. Selling price of Baka. This is what I need. So can somebody figure out? I'll wait for 2 minutes. Can somebody figure out what will be the selling price of Baka in this case? Can somebody figure out selling price of this 90,000? How much is it? Yes. Can somebody figure out selling price कितना होगा? Same 90,000. Sheena Jain is saying it is going to be 90,000. Any other answer? Any other answer? Guys, please respond. K. Shivashankar. Acha, Aditya had asked a question. Sir, can a company acquire a controlling stake in a company in which the going concern is in doubt? Going concern is in doubt. I don't see anything wrong in acquiring, but the thing is, why would you do that? Okay, unless you have a strong turnaround strategy, why would you normally acquire a company where going concern is in a doubt? Okay, so but you have these airline acquisitions, etc., which are happening, where they went into the IBC and then they did a resolution. So ultimately, like Jet Airways is now being taken over by those investors. So you could be having, okay, but it's not a regular precedent. It's a, okay. So this is your question, Sheena. All right. Okay. Any other answers? Anyone? Yes. Any other answers? Shivashankari, are you there? Trying. Yes. Another minute. Sheena Jain modified her answer. She's saying 1,20,000. Anybody else? Anybody else? Aditya, if you're watching, what do you think will be the answer? Okay, so 1,20,000 is the right answer. Okay, so these adjustments, you know it. Okay, so continue the working note. Books of Baka Limited. You have Aqua Limited's account. Aqua Limited's account. Okay, now Aqua Limited's account, I would be having typically by purchases. This was worth 1,80,000. And if you look at the question, as on 31st March, Baka's accounts payable showed 60,000 due to Aqua on the two transactions. So closing balance is 60,000 payable to Aqua on two transactions. Which two transactions? Purchase as well as sale. Okay. So to balance carried down. To balance carried down. This is how much? 60,000. How do I know this? This is given to me in the question. So just total this up. This comes to 1,80,000. This also comes to 1,80,000. So I am left with 1,20,000. What is this 1,20,000? This is the sale value of the goods. This is the sale value of these goods. Is it okay? This is the sale value of the goods. Now, because of these adjustments, impact on Baka's standalone financial statements. Because of this, what is going to happen? Well, first thing, inventory goes up by 90,000. I purchased 1,80,000, returned back 90. So my inventory has gone up by 90,000. Trade payables. This outstanding is there. So that has gone up by 60,000. That has gone up by 60,000. And finally, I have my profit. Sale value 1,20,000, purchased for 90. So this also has gone up by 30,000. So assets also went up by 90. Liabilities and profit also together went up by 90. So balance sheet tallying should not be a problem now. So now you have this restated balance sheet. You have this restated balance sheet. The inventory was worth how much? 3,50,000. The inventory was worth 3,50,000. Okay. So give the effects. Give the effects. Opening inventory 3,50,000. 20,000 got spoiled in fire. And out of that Aqua Baca intercompany, there is still a balance of 90,000. There is still a balance of 90,000. So this comes to 4,20,000. This comes to 4,20,000. In your reserves, you have 2,05,000 minus 5,000 loss on that fire. Then you are also having that 30,000 profit. You are also having that 30,000 profit. Which profit? Sale of goods from Baca to Aqua. Okay. So this comes to how much? 2,05,000 minus 5, 2 lakh plus 30, 2,30,000. Next, what I have is debentures. 15% debentures, non-convertible. That means this is a liability, 3 lakhs. 3 lakhs. Then I have trade payables. Then I have trade payables. What is your trade payables? 2,80,000 plus 60,000. Plus 60,000. 3,40,000. This is done. This is done. Other liabilities, this is done. So your other liabilities worth how much? 40,000. Worth 40,000. Okay, so take up this total. 5, 2, 7, 3, 10, 3, 13, 14. 14 lakhs, 10,000, and this is 6 lakhs, also 14 lakh, 10,000. So with this, I have restated the balance sheet of Baca Limited. I have restated the balance sheet of Baca Limited. Okay. And now when you do the consolidation, you will take the balance sheet of the parent from the question. You will take the balance sheet of Baca Limited from your working note 1. And then you will proceed to do the consolidation. Okay. So we already have done the first part, and we have prepared the consolidated workings also. So now let us just proceed to do this consolidation part. These figures will come from the question, whereas these figures will come from working note 1. Okay. So property, plant and equipment. This is worth how much in the question? Now I'm doing it regularly, whatever we have studied. Okay. So this is going to be worth 6,50,000. So Aqua Limited 6,50,000. Whereas in the case of Baca, can I look at this? No, I will have to look at my own working. So in my working, this is worth 4,05,000. 4,05,000. Okay. Next one is investment in debentures. So I am done with this part. Then investment in shares, this goes in COC account. Investment in debentures, nothing is given, taking it as a liability. So here it will be an asset, 1,50,000. So this is 1,50,000. 1,50,000. Next one, inventories, accounts receivable, cash bank, 2,150 and 80. And then I have I have 15% debentures. How much is that worth? That is worth 3 lakh rupees for the subsidiary. Okay. ₹3 lakh for the subsidiary. Next one, subsidiaries we are checking. So this is done. Then trade payables 3,40,000, other liabilities 40,000. Right. So this is 3,40,000. This is 40. And then you would be having other items, just fill it up. Inventories, trade receivables, cash and cash equivalents. So inventory 4,20,000, trade receivable 265, and cash bank 320. Okay. So this is 4,20,000, 2,65,000, 3,20,000. Then I have my accounts payable here at 3,80,000 and here at 2 lakhs. Okay. So this is $3,80,000 and 2 lakhs. Is it okay? Have you understood so far? Have you understood so far? Yes or no? Any doubt so far? Have you understood? Yes. So far, have you understood, everyone? Okay, great. So all right, fine. So that takes care of the first part. And now we do the regular steps after assets and liabilities. Equity, whose will come? The parent's equity will come. That is 10 lakhs. So we take up this 10 lakhs, shares of 10 each. So that is 1 lakh. Okay. So 1 lakh equity shares of rupees 10 each, fully paid. So that is 10 lakhs. So you can take this to the balance sheet. We'll do it later. Consolidated other equity, you are having accumulated profits and reserves. Accumulated profits and reserves. So working note 4. Now this will be your standalone Aqua Limited. How much is that worth? 4,50,000 before any adjustments. Cost of control account, what is left now is this. This I have taken. What is left now? These three items are done. Investment 8 lakhs. Okay. Investment 8 lakhs. The question is, what is going to be my stake? What is going to be my stake? So I will check these number of shares, 40,000. Baka, how many shares are there? 5 lakhs divided by 10. So that means 50,000 shares. So my stake is 40 by 50. That is 80% stake. That is 80% stake. Okay. So 80% stake. All right. So now what is left is elimination of equity capital, analysis of reserves. Have I considered PPE? Yes. Have I considered equity? Yes. Trade receivables? Yes. Cash bank? Yes. Share capital I eliminate right now, and profits and reserves I start to analyze also right now. Okay, so now with this, let us proceed to the question, to the answer. 5 lakhs we do the split. So by equity share capital, this is of the subsidiary. 5 lakhs ka 80%. Yes. Next one. NCI is having a 20% stake. Nothing is given, so proportionate share of net assets. You can write into bracket assumed. You can write into bracket assumed by equity share capital. How much is that? 5 lakhs into 20%. So that comes to 1 lakh. That comes to 1 lakh. Is it okay? Yes, 5 lakhs into 20%, that comes to 1 lakh. Okay. Next one. Next one. 6. Baka Limited's reserves we will have to analyze. What are the reserves? We will check. That is 2,30,000. That is 2,30,000. Okay. So analysis of reserves. Accumulated profits and reserves as on 31st March. This is worth 2,30,000 of Baka. All right. So now we will be splitting this up. This is pre. What do you mean by pre? Up to the date of acquisition. When was the acquisition done? 1st January 20x5. That is up to 1st January 20x5. Uske baad, this is 75,000. 75,000. Post acquisition is right from post is right from 1120x5 to 31st March 20x7. So what will be the figure? Sir, that is going to be a balancing figure. 2,30,000 minus 75,000. So 2,30,000 minus 75. That leaves you with 1,55,000. Okay. Do I have any adjustment? Yes, I have a downstream transaction. So if there is a downstream transaction, parent sold goods to the subsidiary. So when parent sold the goods worth 1,50,000 were sold for 1,80,000. I'm talking about the first part of the transaction, this part. Okay. Parent selling to the subsidiary. This is having a profit of 30,000. This is having a profit of 30,000. Out of this 1,80,000, 90 were sold back to Aqua, and further Aqua sold it to outsiders. Aqua sold it to outsiders. So now you tell me, out of this 30,000 intergroup profit that was there, this 30,000, how much of it is actually realized? Or out of that, 15,000 is already realized. So the remaining 15,000 is an unrealized profit, which is present in the stock, and therefore we will have to eliminate that. Kiska profit hai? Parent ka. So P&L Aqua Limited account debit, which ultimately goes to consolidated P&L. So P&L Aqua Limited to inventory 15,000. Okay, to inventory 15,000. All right. And apart from that, what else is there in the question? Nothing else. I think nothing else. So this sale has happened later on. Okay, on 13th March 20x7. That means after the date of acquisition. So as on the date of acquisition, whatever pre-reserves were there, we are not going to touch them. We'll directly split it off and close it. Okay. So you are having this figure. So now you split this up. Aqua and NCI. 20%, 80%. 15,000, 60,000. This will go to COC account, which is working note 5 in this question. This will go to NCI account, which is working note 6. Same thing we will do with the post. Subsidiaries' profits are not getting affected because of the sale from Aqua to Baca. Sir, but Baca also sold some goods to Aqua. Yes, it sold those goods at a profit. Yes. But those goods are already sold by Aqua outside, and therefore that profit is realized. See, to make unrealized profit adjustment, the transfer should have happened at a higher amount than the cost, and those goods must remain in closing stock. In the case when Baca sold the goods to Aqua, Aqua ultimately sold it outside and recovered the amount, and therefore no adjustment is needed. Okay. So when I do the split of this also will go between Aqua Limited, NCI. 80%, 20%. One 1,24,000 and 31,000. Where will this go? consolidated P&L. Working note 4. Where will this 31,000 go? NCI. Working note 6. Have you understood so far? Yes. Downstream transaction effect understood. Upstream, nothing is to be done because it is sold to outsiders. Okay. So now that is done. Let us post it by pre-reserves. This coming from working note 7. So this is 60,000 and then NCI by pre-reserves. So this comes to 15,000. This comes to 15,000. Is it okay? Yes. Post reserves, can I record it here? Very well, you can. So by post reserves, working note 7, 31,000. 31,000. Okay, so that takes care of this. Coming to consolidated profits, add share in post reserves, whose working note 7, 1,24,000. Okay, so that is done. 7 is done. We have an inventory adjustment. First one, downstream. When I say inventory, it is basically unrealized profit elimination. Unrealized profit elimination. So there is a downstream transaction. From whom to whom? From parent to subsidiary. Worth how much? Cost 1,50,000, selling price 1,80,000. Out of this 1,80,000 selling price, the subsidiary sold back 50%. So 90,000 is in stock. And because 90,000 is in stock, the unrealized profit in that is going to be how much? Sir, that is going to be half of the profit. Half is in stock, so half of the profit. So therefore, ultimately it is how much? Total profit was 30, half of that is 15. So you will do a reversal of 15. Okay. So you can write down profit on downstream sale is equal to rupees 30,000. Now in your downstream sale, 50% ultimately sold to outsiders. 50% stock lying with Baka Limited. Stock lying with Baka Limited. So this 50% means, therefore, realized profit is equal to 30,000 into 50% is equal to 15,000 is equal to 15,000. Do I need to do any adjustment? No, it is no longer unrealized profit. So you can write here, no adjustment needed. However, in respect of stock lying with Baka Limited, unrealized profit is equal to 30,000 into 50%. So that is 15,000. So do I need to adjust this? Yes, this I need to adjust. What will be the journal entry? It is an downstream transaction. So profits are there in the subsidiaries books. We will have to remove that. P&L of Aqua Limited, debit 15,000 to inventory. Where is the inventory? It is with Baka. 15,000. It is worth 15,000. Where will these items go? Well, P&L is going to go to working note 4 in this question, and inventory is going to go to note 1. Inventory is going to go to note 1. It's note 1. Okay. Upstream. Upstream. In the case of upstream transactions, will you be having any adjustment in the case of upstream? Answer is no, because whatever the subsidiary sold to the parent sold it entirely to the outsiders. No adjustment needed, as goods are ultimately sold to outsiders. As goods are ultimately sold to outsiders. Is it okay? So no further adjustments needed in this regard. Okay. So here, less unrealized profits. So this is from working note 8. So what is your unrealized profit? Sir, my unrealized profit is 15,000. Unrealized profit is 15,000. And go to this note number 1. You are having inventories there. So in inventories, what all are you going to record? Minus 15,000. Minus 15,000. Minus 15,000. Is it done? Yes. Yes or no? Any doubt so far? All clear? Shiv Shankari, Sheena Jain, Het Patel, Aditya, all clear? Please confirm. Yes, Aditya has confirmed. Shivashankari confirm. Sheena Jain confirm. Yes. Two adjustments are remaining. That is intercompany eliminations, right? So working note number 9, intercompany elimination. Intercompany elimination. So what are my intercompany elimination? First one is that 60,000 balance is there between the parent and subsidiary. So we will have to eliminate that. The next one is the debentures that are there. We will have to eliminate that. Okay. So first one is intercompany debtor creditors. Yes. So here the entry will be trade payables debit to trade receivables. That is worth 60,000. Where will this go? Note 1. Note 1. Okay. The next elimination is intercompany debentures. So entry will be 50% debentures debit. How many debentures are they holding? 1,000 debentures. So 1,000 into 100, that is 1 lakh. So 1,000 debentures into rupees 100. 1 lakh. Leave about 2-3 lines to investment in 15% debentures. So how much does that come to? 1,50,000. So a liability of 1,50,000 is notionally getting, a liability of 1 lakh is notionally getting settled for 1,50,000. So the difference is nothing but loss on settlement. The difference is nothing but loss on settlement. 50,000. Loss on elimination. Elimination is right, not settlement. Okay, so this goes to consolidated P&L. 50,000. Okay. So now less loss on elimination of debentures. 50,000. 50,000. Okay. Now go to your note number 1. These debentures are ultimately getting eliminated. So minus 1,50,000, and here it is going to be minus 1 lakh. Important thing, see, same things are there, but amount for eliminations are different. Okay. All right. Next one is trade payables, trade receivables. Minus 60, minus 60. Okay. So does that take care? Yes. So now what you are going to do is this comes to 10 lakhs 55,000. This is 0. Inventories 2 lakh plus 4 lakh 20 minus 15. So 6 lakhs. What is happening? 6 lakh 5,000. Trade receivables 1 lakh 50 plus 265 minus 60. So this comes to 3 lakh 55,000. Cash and cash equivalents 4 lakhs. Debentures remains at 2 lakhs. This is in net 2 lakhs. And then this is 340, 320, 340, 6 lakh 60,000. And finally 2 lakh 40,000. 2 lakh 40,000. Equity share capital is done. Just your reserves, you need to take the total. Five lakhs 9,000. So this is 5 lakh 9. 5 lakh 9. Balance your cost of control account. Three lakh 40,000. This is your goodwill. So go to your balance sheet. Goodwill is coming from working note 5. Three lakh 40,000. NCI is there, for which we take working note 6. Total this up 1 lakh 46,000. So closing balance 1 lakh 46,000. Okay, but after that you just populate these figures into the balance sheet. Your balance sheet should tally. Your balance sheet should tally 27 lakh 55,000. 27 lakh 55,000. That should be the total of your tallied balance sheets. Okay, all adjustments are done. You just have to populate the figures in there. It will tally, it has to tally. Okay, no doubts about that. Have you understood? Have you understood, guys? Yes, Sheena Jain, Aditya Shivashankari, Mrs. Patel. Have you understood? Are you putting in the figures right now? Please confirm. Done. Okay. Acha, Tanushri is there. Very good. Okay. All right. So that takes care of that important question. Basically, the new things that we studied in this question was, one is restatement of balance sheet for after adjusting for material events. The next one was, of course, upstream, downstream was there. The third one is the intercompany eliminations, in particularly the debentures, Okay, so that takes care of your question number 46. Okay, all right. We then move on to the theory part, where we will write down uh, a small note on parallel subsidiaries. Note on parallel subsidiaries. I won't call it as exactly a consolidation adjustment, but you could be having something known as a parallel subsidiary. So that is why we are going to write it now. And then we will do the dividend adjustment, which is a very important adjustment. And after the dividend adjustment, we will do a question that has parallel subsidiaries. Okay. So dividend adjustments, parallel subsidiary is not very important. You will understand as we speak also. But what is important is dividend, and after that, chain holding. So these two are the next very important adjustments. And then you have two small adjustments, that is additional stake purchase and additional stake sale. So with this, I think we should kind of almost put curtains on our Ind AS 110 with these adjustments. There is a small theory, that is, are there any exemptions on preparing consolidated financial statements? So we'll just study those exemptions in the next class, hopefully towards the end. And then you will have joint operations, joint arrangements, that is Ind AS 111. I have just a very small, it's not even a half an hour job for me, okay, because primarily it is theory. You just have two problems specifically, so to speak. It's very simple. Okay, so we are falling behind a little bit, but let us try to cover up. So parallel subsidiaries means what? I have my parent. This parent has multiple subsidiaries. Okay, S1, S2, S3, S4. So now when I do the consolidation, first thing is compute the stake. What is the stake in each of these subsidiaries? The next one is we prepare note 1. In note 1, we will prepare for all the companies. So I will have parent, S1, S2, S3, S4, adjustment and total. Okay. So you will then follow the usual consolidation process. You will then follow the usual consolidation process. And after that, in your COC account, you will again prepare separate cost of control accounts, one for S1, one for S2, one for S3, one for S4. Alternatively, what some people suggest is you could follow columnar cost of control. So you will have 4 plus 4, 8 amount columns and 2 particulars columns for debit and credit. And then you can do the cost of control account. You can do the NCI account also in that manner. And when you do analysis of reserves, each reserve would be, each entity would be analyzed separately. Acha, now sir, if I get NCI of S1, S2, S3, S4, I will have 4 NCIs. Can I add them and present a single figure? Yes, it is permitted. Sir, I have goodwill also multiple figures. So that is cost of control account. S1 will have goodwill, S2 capital reserve, S3 goodwill, S4 goodwill. Sabka apna apna rehta hai. So now can I present it net? Answer is yes. You have to present it as net. There is no need for you to show individual items of goodwill and capital reserve. Okay. So you can write down step 1. Step 1. Calculate stake in each of the subsidiaries. And determine date of acquisition. Zaruri nahi hai that it is the same date. All are on the same date. There could be different dates. Okay. Next one. Step 2. Consolidate assets and liabilities of all subsidiaries. Into bracket S1, S2, S3 and S4. Okay, S1, S2, S3 and S4 in note 1. Step 3. Prepare COC account and cost of control account and NCI account in columnar form. Net goodwill, NCI, capital reserve only to be taken to the consolidated balance sheet. You don't have to show the goodwill, etc. separately. Okay. Step 4. Reserves of each company to be analyzed separately. Reserves of each company to be analyzed separately. Okay, so these are the steps that we will typically be following for parallel subsidiaries. And with this, we are fairly now set to pick up our next adjustment. Just note this down quickly. Do you want to start with dividend adjustment right now, or do you guys need a break? I have to complete my dividend adjustments today. I also have to complete, if possible, one question on parallel subsidiaries, and thereafter stake sale, stake purchase, if time permits. Okay. So do you need a break, or can we continue with dividend adjustment right now? It's a very important adjustment, by the way. Okay. क्या बोलो, ब्रेक चाहिए? We will start after the break. Okay, fine. Agreed. Take a 10-minute break. We will resume at 8:55. Okay, we will resume at 8:55. Take a 10-minute break. Okay. Be fresh for discussion on dividends. Okay. Okay, all right. So welcome back, guys. You are fresh. So now we discuss. The most important adjustment, that is dividend. Okay, that is dividend. All right. So now coming to dividend. You need not note this down. This is just like how we discuss the concept first. Then I will be giving you a detailed understanding of detailed theory note of the dividend adjustment. Okay. So suppose this is the first scenario. Okay. I have subsidiary. This is as on 31st March 2021. This is the small balance sheet of the subsidiary which is given to us. Equity share capital 1 lakh, P&L 10,000, net assets 1,10,000. $1,10,000. Okay. On 31st March 2021, P acquires 90% stake in S for 1,20,000. Okay. So this is the fact pattern which is given to you. This is the fact pattern which is given to you. So now P Limited's balance sheet looks something like this. P on 31st March 2021. Nothing is there with P. Okay, only assets and equity capital. Okay, so equity share capital 1,20,000. Investment in S 1,20,000. So this is your fact pattern. Okay. So now if I proceed to calculate the goodwill, I can do it by two methods, either by Ind AS 103 or I can do it using the 110, that is the cost of control account. We'll check up both the methods. Okay. So identify the acquirer. P, date of acquisition is 31st March. 1,20,000 is the purchase consideration. Step number 3. Step number 4, net assets is worth 1,10,000. Step number 5, NCI will be taken proportionate share. Step number 6 is goodwill. Goodwill will be purchase consideration 1,20,000. This is for 90% stake. Add NCI. NCI will be 1,10,000 into 10%. So that comes to how much? That comes to 11,000. So this total comes to 1,31,000 less net assets. This is the full value. So this comes to 1,10,000. So we are left with a figure of 21,000, which represents your goodwill. Okay. So this is 103 method. Now, if I talk about Ind AS 110 method, where I prepare the cost of control account, the position looks something like this. I have a 90% stake. So by equity share capital, this is going to be 1 lakh into 90%. 1 lakh into 90%. So 90,000. Investment in S 1,20,000. Okay. And then pre-reserves is going to come. So I take my pre-acquisition reserves. Working note 4. Analysis of reserves. Kitna hai mera reserves? Well, I have only one reserve that is worth 10,000. So a P&L 10,000. This I ordinarily split up between pre and post. Pre is 10,000, post is 0. So 10,000, I will again split it up between P and NCI. So this is 9,000 and this is 1,000. So 9,000 goes to COC account. This goes to NCI account. So by pre-P&L, 9,000. So now when I balance this 1,20,000, 1,20,000, I'm left with how much? I'm left with 21,000 as goodwill. So you should be convinced. You should be convinced right now that both the things give the same answer. Okay. So now, for reasons best known to these companies, they remained idle throughout the year. They remained idle throughout the year. P also did not do anything. S also did not do anything. Okay. So if they remain idle throughout the year, what is going to happen is S Limited, as on 31st March 2022, is going to look the same way. कोई transaction नहीं हुआ है. Okay, there is no transaction. कुछ नहीं किया. So equity share capital 1 lakh, P&L 10,000, net assets 1,10,000. So position is like this. Okay, position is like this, and P Limited's position is something like this. No major change. This is on 31st March 2022. Equity share capital 1,20,000. Investment in S 1,20,000. Okay. So this is the picture. Now, what happens is on the 31st March 2022, that is the last day of the year, the parent company decides that subsidiary should issue the dividend. That subsidiary should issue the dividend. So it says that, well, you issue the dividend out of these pre-profits of 10,000. Can the subsidiary issue this dividend? Answer is yes. Is it legally permitted? Answer is yes. What you need to do, to issue the dividend, you need to have balance in your distributable reserves. So P&L is a distributable reserve. But sir, this is before the acquisition. Doesn't matter. What is the big deal? Today P Limited is holding. So whenever the dividend is issued, P is going to get those dividends. Okay. So what entry S will pass? Well, S is going to pass the entry P&L appropriation account debit, P&L appropriation account debit to bank. So this comes to 10,000. Do you agree with this? Yes, this is the dividends which are declared. This is the dividends which are declared. So post the declaration of dividends, what will happen is my P&L appropriation becomes 0. P&L becomes 0, entire balance is distributed, net assets will fall to 1 lakh and balance sheet total becomes 1 lakh. So this is your impact on the standalone balance sheet. Now what happens to P Limited? P Limited gets the dividend, so bank account debit. How much dividend P will get? Will it get entire 10,000? No, it cannot get entire 10,000. It can get only the amount that it is holding shares in. So the amount that it is holding shares in is 9,000. So it is going to get bank account debit 9,000 to dividend income. To dividend income 9,000. To dividend income 9,000. And therefore the balance sheet looks something like this. Now, this is income for P. This is income for P. So this goes to the profit and loss account worth 9,000, and here I will have bank balance worth 9,000. So this comes to 1,29,000. Are we on agreement up till now? Are we on agreement up till now? Have you understood the situation so far? Yes. Have you understood the situation so far? Any doubt so far? Because now, see, I want you guys to interact, those who are watching. Okay. Step by step, we are making the things a little more technical now. So if you have understood so far, please let me know. If you have any doubts at this stage, please let me know. Okay. See, you would have studied something known as pre-acquisition dividends under AS 13, where those dividends were adjusted against the cost of investment because they were declared out of pre-acquisition profits. That was the facility, or that was the guidelines which was there under the AS 13 regime. In Ind AS 109, anything is coming from equity instruments in the form of dividends, that has to mandatorily go to the profit and loss. You cannot take it, you cannot adjust it through the investment cost, because anyways equity instruments would typically be carried at fair value, whereas in the case of investment in parents, etc., Ind AS 27 permits you to take it at cost. You cannot modify that later on. Okay, so it is going to the profit and loss account. Have you understood so far the standalone balance sheets as on 31st March 2022? Did you understand? Yes. Did you understand? Yes. Shimona Varshne, difference between P. I didn't understand your question, Shimona. Please let me know. Okay, what is your doubt? The full question has not come. Okay, so Aditya has confirmed. So let us then proceed to the next part. Now, consolidated balance sheet. Consolidated balance sheet as on 31st March 2022. So what happens at the time of consolidation? Well, I prepare first note 1. In note 1, I will have parent, subsidiary, adjustments, total. Okay. So I have assets, bank, everything has come. So parent is having 9,000 worth of assets. Subsidiary is having assets worth 1 lakh. So this comes to 1 lakh. No adjustments here. So this comes to 1,09,000. This comes to 1,09,000. Note number 2 is equity share capital. So equity share capital of the parent is going to come here. So this is 1,20,000. Note number 3 is consolidated other equity. Consolidated other equity. So here I am having P&L. It starts with 9,000 rupees of the parent. It starts with 9,000 rupees of the parent. Then I have working note 1. Then I have working note 1, that is each reserve I will take it. Yahan pe ek hi reserve hai P&L, so I will skip it. Then we have working note 2, that is COC. Working note 2, that is cost of control account. And then I have working note 3, that is my NCI account. That is my NCI account. Okay. Yes. So this is investment in S. 1,20,000. Okay. Investment in S. Okay. Okay. So difference between P&L and P&L appropriation. See, P&L is the reserve. Whenever there are transactions between the company and its shareholders, it is not going to be routed through the P&L account as an expense. So dividends distributed, all these items will go under the P&L appropriation account. It is basically what you do directly adjustment in reserves, any adjustment directly done in reserves. Okay, so dividends go through your P&L appropriation. Something like in your partnership accounts, if you recollect, you had a P&L and later on you had a P&L appropriation where interest on partners' capital, withdrawings of interest, and then profits credited from the partnership. All these items would go to the P&L appropriation. From there, it would flow to the partner's capital. So that is the whole understanding of P&L appropriation. Okay. So investment in S, 1,20,000. Then I'm having working note 4, that is analysis of reserves. Analysis of reserves. Okay. What are the reserves? Sir, my reserves are 0. There are no reserves. Okay. So reserves are 0. How did it become 0? Well, it looks something like this. Okay. And this is the exact fact pattern. I'm not making this up. Pre, post. Well, before there was a balance of 10,000 on 1/4/2021. But later on, there was a dividend that was declared of 10,000, and therefore this became 0. This is anyways 0. So therefore, when I split this between parent and NCI, this is 0. This is 0. This also, when I split between parent and NCI, this is 0 and 0. So is there anything that goes to the parent? No. So by equity share capital, this one though I will definitely split. So 1 lakh, equity capital of the parent is 1 lakh into 90%. So 90,000 by equity share capital, 1 lakh into 10%. So this is 10,000. Okay. And then you balance it, 1,20,000, 1,20,000, 10,000, 10,000, 10,000. Balance carried down. Nothing is left. So this becomes my goodwill. This becomes my goodwill. So now in the consolidated balance sheet, I will be having equity share capital of 1,20,000. Then I would be having P&L of 9,000. Then I would be having net assets of 1,09,000. Then I would be having goodwill of 30,000. And then I would be having NCI of 10,000. Okay, so this comes to 1,39,000, 1,39,000. And now consolidated balance sheet is done. Okay. So now what I want you to tell me, if you have been attentive in the session so far, look at the consolidated balance sheet on 31st March 2022. Look at the consolidated balance sheet on 31st March 2021. Okay. Where is the consolidated balance sheet here? Did I prepare? Analysis of reserves. Consolidated balance sheet. I did not prepare. Doesn't matter. Okay, for your reference, consolidated balance sheet 31st March 2021 looks something like this. All adjustments we have done. Okay, so equity share capital 1,20,000. Net assets was 1,10,000. Goodwill was 21,000. P&L was, sorry, this is consolidated, right? So P&L is not going to come. NCI was appearing at 11,000. So this was my consolidated balance sheet. on 31st March 2021. That is the date of acquisition. This is the date of consolidation. Okay. So look at these two balance sheets. Okay. This as well as this. Okay. And now, friends, you tell me how do you find these two balance sheets? How do you find these two balance sheets? Do they appear correct? Because see, I have done the steps that I have taught you myself. Okay. So it's not that I have skipped anything or I have done some wrong thing. Okay. तो मैंने same किया है. Are you satisfied with the balance sheet or are you having some problems with this balance sheet? The consolidated balance sheet as on 31st March 2022. Is it okay? Is it not okay? If it is not okay, what is not okay? Please elaborate. Okay. You can give me simple one-line answers. You can give me simple one-line answers or one-word answers. Okay, but first tell me, is this consolidated balance sheet on 31st March 22 correct or not? That is the first question. Is it correct or not? Come on, tell me. Shimona is saying it is incorrect. Can you please tell me why? Others, Shivashankari, are you there? Aditya, are you there? Tanushri, are you there? Vidula, are you there? If you guys are there, tell me, is it correct? Is it incorrect? First. Second, why do you think so? Why do you think so? Why do you think so? Shimona, give me the reason if possible. Yes, I need your answers, guys. Come on, put those thinking caps and think about it. Okay, I'll wait for 2 minutes for your answers. Sir, goodwill. Okay, so Shimona has raised 1 point. That is, sir, goodwill is at 21,000 on the date of acquisition, whereas it became 30,000 on the date of consolidation. Excellent. Anything else? Anything else? Be free, guys. I'm not here to get angry on you or not going to, blame you. Okay. Difference of 7,000. Nahi yaar, balance sheet is tallying. Difference of 9,000 in the goodwill, not 7. Okay. Otherwise, balance sheet is tallying. No, yeah, balance sheet is tallying. Yes. Okay. Anything else? Shivashankari, Aditya, Tanushri, I'm waiting for you guys to answer. You have been there right from day one almost. Okay. Sheena Jain, are you there? Do you find anything funny in the balance sheet on 31st March 2022? Any troublesome item? I can look at 2 items which are a problematic item. One of them is identified by Shimona as goodwill, which is the other funny item. थोड़ा सा अजीब लगता है. It looks a little bit weird. It looks a little bit weird. Okay. Answers are not flowing. See, what did I tell you? What did I tell you? You are given this balance sheet on 31st March 21. The companies remained idle for entire 1 year. That means koi activity nahi hua. There is no activity absolutely. And when there is no activity absolutely, profit to aayega nahi. You cannot have a profit in that case. If you cannot have a profit in that case, that fact is correctly appearing in the standalone balance sheet. That fact is accurately appearing in the standalone balance sheet. But when I come to consolidated balance sheet, how am I getting a profit of 9,000? Sir, वो तो dividend से मिल रहा है ना? Dividend of S is distributed to P and therefore that becomes a profit. But friends, what is the meaning of profit? Sir, profit means when you transact with outsiders. This 9,000, is it a transaction with outsiders or is it a transaction within the group? Answer is it is a transaction within the group. And in respect of transactions within the group, abhi we have studied just now that inter-group profits and losses have to be eliminated. So this 9,000 is an intergroup transaction. It is dividend from subsidiary given to the parent. That's it. There is no other adjustment to that. So is this 9,000 genuinely representing a group profit? Answer is no, it's not. So that is the second problem. First problem, if I have to elaborate, is the goodwill. I told you goodwill can change only and only under two circumstances. Only under two circumstances. First one is measurement period adjustment and second one is impairment. Iske alawa, apart from this, goodwill cannot change. But in our case, sir, goodwill went from 21 to 30,000 and kidhar se somewhere we got P&L of 9,000 when in fact both the parent and subsidiaries did not do any business at all. And therefore, we have a problem if we do the consolidation just like this. But sir, NCI also has changed. NCI was 11,000. It has now become 10,000. So now we have three items which have changed. And now the question is, which of them is correct, which of them is wrong, and why it is wrong? See, अपने को सिर्फ correct और incorrect से नहीं चलेगा ना, अपने को क्यों गलत है वो देखना है. And at the same time, how do I rectify the mistake? Okay, that is what we will have to look at. Now see, first one. I talk about goodwill. Okay, why goodwill has changed? 31st March 21, this figure was 21,000. 31st March 2022, it became 30,000. Aisa kyun hua? Why did this happen? See, when you were consolidating the balance sheet on 31st March 21, the P&L was 10,000. This entire P&L was pre 10,000. Post, nothing was there. So you had distributed to the parent 9,000, to the NCI 1,000. And because you had distributed this had gone to the COC and ultimately reduced your goodwill. See, the difference between this is 9,000. Okay. It is this 9,000 we are talking about. It is this 9,000. It gets credited to your COC account, thereby reducing the goodwill by 9,000. However, if you look at the next case, in the next year, the P&L was nil. Okay. Agreed it was 10,000, but sir, I have declared dividends out of this 10,000. So this balance is 0. So when I split it up between parent and NCI, it is 0, it is 0. Here also when I split up, it is 0 and 0. So now on 31st March 2022, you are saying that pre-profits are not there only, and therefore there is no amount that will go to the COC. But you are contradicting your own statement here. You are contradicting your own statement here when you are saying that pre-profits are 0. You are saying that pre-profits are 0 on 31st March 2022 when on the date of actual acquisition there were actually physical profits which were present. दिखता था अपने को, you saw that profits were there and then you distributed it. However, on 31st March 22, आप कैसे बोल रहे हो देखो profit नहीं है? When you acquired, profits were there. Today they were not there. Why? Because today it got distributed. But as on the date of acquisition, did you actually have profits? Yes, you had profits. And therefore, it is this difference of 9,000 which is creating this difference of 9,000. Have you understood the first part? Why this goodwill is having a difference of 9,000? Because I have wrongly taken that pre-profits are not there. I have wrongly ascertained that pre-profits are not there on the date of consolidation. And because I have wrongly ascertained this, my goodwill figure has changed. Pre-profits were actually there on the date of acquisition. बस आज के तारीख में नहीं है. That cannot negate the fact that pre-profits were never there. Okay. In this case, you are negating it. You are saying pre-profits were never there. But actually they were there. Actually they will be there. Okay. So first point is this 9,000 difference is a problem. This 9,000 is a problem. So this is the first reason. So अपने को क्या adjust करना पड़ेगा? We will have to adjust this goodwill. What is your goodwill? Sir, my goodwill is 21,000. Goodwill will be 21,000. It cannot change. It cannot change. And therefore, on the consolidation date, it became 30 because of this funny thing which you have done. You have not done anything funny. The reason is the treatment in Ind AS 109, where dividends, whether it is pre or post, 109 says, I have nothing to do. You got a dividend, take it to your P&L, it is your income. Straight away, don't sit and analyze. Okay, so straight away it flows to your profit and loss, and therefore this whole problem is arising. So goodwill becomes 30. I have to bring it to 21,000. Matlab, I have to credit the goodwill. That means I have to credit the goodwill. Goodwill is nothing but COC account. So I will credit the COC account with 9,000. The story is, sir, आप debit किसको करोगे? Whom are you going to debit with 9,000? So we now come to the second part. Consolidated P&L. Consolidated P&L. Tell me, is this an actual earning? Is this 9,000 an actual earning that is happening? Or because of 109 principles it is there, otherwise there is actually no earning? Answer is, sir, there is no earning that has taken place during the year. Are earning ke liye you need to have activities, no? Activities only have not happened. How can you generate the profits? How can you generate the profits? And therefore, on this P&L of 9,000, I have a problem. I have a problem. Nahi ho sakta ye. This is not possible. This is not possible because both the companies were sitting idle. So standalone mein to P&L is not coming. How can you expect P&L to be born without first taking birth in parent and subsidiary? Aisa to nahi hoga na. It cannot happen like this. And therefore, the next problem is this P&L. Okay. So coming to my second problem, that is the consolidated P&L. That is the consolidated P&L. Okay. On 31st March 2021, did I have consolidated P&L? Answer is C. There is no consolidated P&L. Okay. So consol P&L was nil. Suddenly on 31st March 2022, from somewhere in the sky, you are having consolidated P&L of 9,000. When there is no activity, and therefore, why am I having this? Sir, you are having this because of this distribution. ये जो 10,000 is distributed, this is the sole problem. Source of all problems is this pre-acquisition dividend of 10,000. 9,000 belongs to the parent, and therefore what happens is our goodwill figures get distorted and my profit figures get distorted. Standalone basis, absolutely correct. There is no problem. Okay. But the problem arises in consolidated financial statements. And therefore, I will do the adjustment entry by debiting the consolidated P&L to the COC account. Consolidated P&L account debit to the cost of control. Is this correct now? Answer is yes. If I do this adjustment, what will happen is P&L will go away because consol P&L is getting debited. This becomes 0 and goodwill or COC is credited. So this will become 21,000. And now, is this making sense? Yes, this starts making sense. So if I look at my COC account, I will have a new item first. That new item will be by pre-acquisition dividends or consol P&L pre-acquisition dividends. This becomes 9,000. So this falls back to original figure of 21,000. Okay. And this 21,000 is what goes in the balance sheet. This 21 is what goes in the balance sheet. Have you understood? Yes. Aditya, Shimona, Sheena, Shivashankari. Yes, today Sairam is not there. Have you understood? Have you understood? Have you understood? Yes or no? Sheena has given the right answer. Consolidated P&L will be debited against the cost of control account. Done? Did you guys understand? Yes or no? Shivashankari, Aditya, अपने को समझ में आ गया? Did we understand? Yes. So I take it in a positive sense that you have understood, because answers are again not flowing. Okay. So I take it that you have understood. So let us then proceed further. Okay. Let us proceed further. All right. So now case 2, I modify this only. Okay. So this is case 2. Share capital on 31st March 2021 is exactly the same. So all these figures remain the same. Okay. Next one, on 31st March 2022. On 31st March 2022, it looks something like this. NCI को कोई dividend मिला ना? See, 1,000, that is why it has gone, no? 1,000, that is why it has gone. Okay, so now I will discuss. Sir, there is a movement in NCI. I told you 3 figures had changed. I discussed only 2. Third one, NCI. Well, on 31st March 2021, NCI balance was 1000. On 31st March 2022, NCI balance became 10,000. Yes, 11,000, 10,000. Sir, is this figure wrong or is this figure correct? ये wrong नहीं है. This is not wrong because this difference of 1,000 is nothing but the dividend that is given to NCI also. The dividend that is given on NCI also. And therefore, if you look as on this date, net assets were 1,10,000. Look at the balance sheet. This is note number 1. This is case number 1. Net assets were 1,10,000 and therefore your NCI had to be 10% of that. So 11,000. Once the dividend is declared, net assets became 1,00,000 and therefore in this case, this also comes to net assets being 1,00,000. Net assets being 1,00,000. Okay. So this is correct because your NCI is proportionate share. So 10%, 10%. Ultimately, NCI means you are actually making a dividend payment to outsiders outside of the group. So do you have to record that? Yes, you have to record that. And once you record, this is what is going to be the position. This is what is going to be the position. Okay, so Aditya is asking, sir, but on the consolidated date, although we are having pre-acquisition reserves, we paid 10,000. And on the consolidated date, the reserves don't exist. That is the fault, with our working. Yahi to fault hai. This is the fault that is there. See, in this case, you are saying that pre-acquisition reserves do not exist as on 31st March 2022. But look at the statement. You are saying that pre-reserves do not exist on 31st March 2022. But they existed actually on 31st March 2021. Yes. So how can you change the facts which were present on 31st March 2021 in 2022? How can you modify this reality? You are modifying this reality here. The reality was 10,000 was physically present. Today you are saying that balance has become 0. Sir, but dividend is declared. Arey Baba, dividend is declared today, no, on 31st March 22. So pre-reserves becoming 0 is a fact of today. It is not a fact of 31st March 21. So today, how can you go back in time and change the pre-acquisition reserves? You cannot go back in time. Apne paas time machine nahi hai that I go back in time and adjust it. And therefore, we say that pre-acquisition reserves cannot, I repeat, cannot be changed today retrospectively. When you do this nil, it means you are retrospectively changing the existence of pre-acquisition reserves. जो reserves आपके असल में थे 2021 में, आप उसको डिस्ट्रीब्यूट करके ये जता रहे हो कि वो रिजर्व्स 31st मार्च को थे ही नहीं. अरे थे ना बाबा, अभी डिविडेंड डिस्ट्रीब्यूट किया इस साल में. उस साल में तो नहीं हुआ ना, उस साल में तो था. And therefore they cannot be adjusted and made 0 like this. If you make this, your goodwill figures start to go incorrect. Okay, start to go incorrect. Is it okay? Yes, Aditya, did you understand? Shimona, did you understand? NCI को भी dividend मिल रहा है ना 1,000 रुपए का. Yes, NCI को भी dividend मिलेगा. NCI will get. That is why parent share I have taken only parents share I have taken to be only that 9,000. 10,000 में से 9,000 is to the parent, 1,000 goes to NCI. 1,000 goes to NCI. Okay, all clear? Yes. So, is NCI figure correct? Absolutely. Absolutely. When you give them 1,000 rupees dividend, their claim to that extent goes down. And therefore, NCI from 11,000, it becomes 10,000. It becomes 10,000. Is it okay? Yes. Have you understood dividend adjustment? So now we move on to the next case, that is case number 2. Case number 2. Okay. ये तो same है. So whatever is there initially, it is exactly the same. Next one. Next one. The story goes something like this. Okay. So this is again 10,000. Okay. So this comes to 1,10,000. 1,10,000. Sir, what is this 10,000? Well, you had opening balance of 10,000 in the beginning. Okay. You had opening 10,000, then profit after tax of 10,000, and then you declared a dividend from profit after tax of 10,000. You declared, I think it is sufficient, Shimona. Nothing else is needed for November 22. Okay. It is fine. There is no need. Okay. All right. So now this 10,000 plus 10,000 PAT, and then whatever PAT you earned, you distributed that as dividend. Whatever profit after tax you earned, you distributed that as dividend. So P&L is 10,000, 1,10,000, 1,10,000. Now, what will be the situation with the company P Limited? What will be the situation with the company P Limited? Sir, P Limited is going to get the dividend. So P Limited's balance sheet is going to remain the same. P Limited's balance sheet is going to remain the same. There is no change in this balance sheet. There is no change in P Limited's balance sheet. S Limited's balance sheet, it appears that it is the same 10,000. Okay, but it is not. It is opening pre 10,000. During the year, you did some operations, earned 10,000. That 10,000, you are giving it off as dividend. You are giving it off as dividend. And now we do the consolidation. Now we do the consolidation. Okay. So let us quickly pick up the consolidation. All these notes, everything remain the same. The main thing that is there is this side. Okay. ये अब nil नहीं रहेगा. Okay. This is not going to remain nil. Okay. So this becomes 10,000. This becomes 10,000. Pre is 10,000. Post is 10,000 minus dividend declared. Post acquisition 10,000. So this becomes 0. So parent NCI 0, 0. Goodwill, no further adjustments. Okay, so this is directly 10,000. Okay, so this one I will split between parent and NCI. I will split between parent and NCI, and this comes to 9,000 and 1,000. This comes to 9,000 and 1,000. So go to your COC account. You will be having by pre-reserves or pre-P&L 9,000, 21,000 goodwill. That's about it. So here I will be having the goodwill again appearing at 21,000. NCI appearing at, this is 1000 plus share of that uh, equity share capital. Okay, equity share capital कितना है? Subsidiary का equity capital कितना है? 1 lakh. So उसका 10,000. So 10,000 plus अकाउंट बना देते हैं NCI का. Equity share capital. What is the equity share capital of the subsidiary? Hmm. 1 lakh into 10%. Then thereafter, I have NCI balance pre-acquisition reserves. This is another 1000. This is another 1000. And additionally, what is happening is we are making payment to NCI of dividend. So NCI account debit to bank 1000. Okay. So ये 11 closing balance 10,000 to bank. What is this 1,000? Well, this 1,000 is nothing but dividend that was given. Okay. So therefore, it comes to 10,000. So apna NCI is going to look something like this. Okay. NCI 10,000. That's it. So this comes to 1,30,000. 1,30,000. And that concludes your issue. Yes. What did I do? मैंने कुछ गड़बड़ किया क्या? Did I make any mistake? नहीं. Analysis of reserves 10,000, post nothing is there. Pre-acquisition 10,000, 9,000, 1,000. Okay. So in my NCI account, pre-acquisition to bank. Okay. 10,000. Is it okay? Is this balance sheet fine? Is this balance sheet fine? One second. Something is wrong. ये गलत लिया मैंने. So this becomes 1,19,000. Yes or no? Yes. Parent is getting the money in the bank. So this becomes 1,19,000 If I look at NCI, equity share capital 10,000, 1,000. So this is 10. And now I will have P&L appearing at 9,000. This is not right. This is not right. This appears at 11 only. Yeah, my mistake. 11,000. So here my NCI comes at 11,000 and this tallies it at 1,40,000. Yeah, this is fine. So now you tell me, is this consolidated balance sheet okay? Now you tell me, is this consolidated balance sheet okay? I started with note number 1. Net assets of P is 9,000. 9,000. Net assets of S 1,10,000. 1,10,000. Total is 1,19,000. Equity share capital of the parent is what is going to come. Note number 3, P&L 9,000 is what is going to come. Then I have my NCI account. Ignore this NCI. I have prepared NCI separately below. Okay, so this NCI is going to have equity share capital 10,000 and pre-reserves this 1,000 which comes here. So NCI is worth 11,000 and that kind of concludes my discussion. In COC account, I will be having where is my cost of control? Investment 1,20,000, 1,20,000. Then I would be having 90,000 of the equity capital of the subsidiary. Pre-P&L 9,000, 9,000, leaving you with a goodwill of 21,000. Okay, and that concludes my balance sheet. So now you tell me, consolidated balance sheet as on 31st March 2021 appears as this only. Okay, 1,20,000, 11,000, 1,10,000 and 21. And now you tell me, check these balance sheets. Okay, this balance sheet and this balance sheet. And tell me, is there anything funny that you are looking at? Is there anything funny that you are looking at, or it is fine? Yes. Are you guys there with me? Yes. Are you guys there with me? Yes or no? अरे बोलो, आप हमारे साथ हो या हमारे खिलाफ हो? Are you there with me or do you disagree with me? Do you think anything funny is there in the balance sheet on 31st March 2022? Or do you think, sir, it is fine, there is no problem? What do you think? What do you think about this? Is this fine? Is this fine? Is this fine, or is there anything funny that you are seeing? Sheena Jain, Shimona Varshne, Aditya, is there anything funny that you see in this balance sheet? Net assets, is there a problem? Goodwill, is there a problem? NCI, is there a problem? P&L, is there a problem? Equity capital, is there a problem? Is there a problem in any of these figures? Is there a problem in any of these figures? Is there a problem in any of these figures? Come on, guys, speak up. See, if you speak up, it becomes a meaningful session for me also. Okay. Sir, we have distributed to NCI out of opening P&L. Correct, because opening reserves are only there. Okay. We can also distribute to NCI out of current year's profit. See, the source of dividend will be the same for the parent and the NCI. You cannot say I will give parent out of current profit and NCI out of pre, or you cannot think vice versa. Okay. So when you are saying dividend, I take it distribution is in terms of dividend. Okay. So if parent gets out of current, NCI also gets out of current. As far as allocation of pre-acquisition profits are concerned, that also has to go both to the parent and the NCI. So there is nothing wrong in this. Okay. So there is nothing wrong in this. All right. Shimona is saying there is a problem with the P&L. And probably she's saying there is a problem with the P&L because again, this is intercompany dividends. Again, this is intercompany dividends. Okay. So let us understand and try to do a detailed understanding of the figures once again, like how we did in the earlier case. Okay. And now please pay attention. Now you please pay attention. This is the last part of discussion on the dividends. Iske baad we straight away move to do the questions. Okay. We have one question to do on dividends, and that should kind of, conclude your understanding. So look at your goodwill. Goodwill in the original balance sheet was at 21,000. Here also it is at 21,000. Is it the same? Yes. No change. So will you modify anything related to goodwill? Answer is no, you will not. The second one is consolidated P&L. The second one is consolidated P&L. Acha. So let us take consolidated P&L as on 31st March 21. This was 0. As on 31st March 2022, this became 9,000. Now the question is, sir, how this became 9,000? How this became 9,000? The parent did not do any activity. It was the subsidiary which did some activity. And because the subsidiary did some activity, it is declaring dividend from there. And that dividend is what is coming here. Parent khud kuch nahi kar raha hai. The parent is not doing anything. So now let us just forget for the time being. Let us just forget for the time being that dividend was distributed. Okay. Abhi kya ho raha hai? Look at the subsidiaries case. Look at the subsidiaries case. In the case of the subsidiary, opening profit was 10,000. In the current year, you earned a profit after tax of 10,000. Okay. So your reserve became 20. And then you declared dividend. Kitne with 10,000 again. Now this dividend, what we have said, sir, this is entirely out of post-acquisition profits. This is entirely out of post-acquisition profits. No problem, Sheena. Go ahead. Okay. This is entirely out of post-acquisition profits. And because this is entirely out of post-acquisition profits, we have done the question accordingly. Now, for the time being, I am telling you, forget that dividend was declared. अभी के लिए just भूल जाओ कि ये dividend था अपने पास. Okay. So if you forget this, can I say that my reserves, that is P&L of S Limited, do they look something like this? Yes. Pre, post. Dividend nahi tha, so this was 20,000. Correct. So 20,000 means pre was 10,000, post was 10,000. Pre goes between parent and NCI in the ratio of 9,000 to parent and 1,000 to NCI. Post also would go to parent and NCI. as 9,000 to parent and 1,000 to NCI. Forget dividend. अभी के लिए dividend भूल जाओ. If you ignore the dividend, can I say that the parent has a retained profit of 10,000? Yes. This retained profit is the profit for the current year. Absolutely yes. This profit was generated when the parent had control over the subsidiary. Absolutely correct. And therefore, can I say that this profit should correctly go to the consolidated P&L? Absolutely right. And therefore, do I take this consolidated P&L? Do I take this share of subsidiaries profit share belonging to the parent? Do I take it to the consolidated P&L? Absolutely right. Sir, what about this NCI? This NCI also you take it? No. Answer is this NCI will not be taken. This is what is distributed, less dividend. This is an actual payment which is made to persons who are outside the group. This is an actual payment which is made to an individual or a group of persons who do not belong as a part of this group, and therefore it is as if I am settling their liability. It is as if I am settling their liability, and therefore ये NCI के पास 1,000 will definitely go. The whole problem arises, the confusion arises. Sir, dividend you distributed, but dividend to intercompany ho gaya na. So how can it become a part of my consolidated P&L? So your answer will then be working note 1, consolidated P&L. It will look something like this. Standalone P Limited. How much is going to come? 9,000 is going to come. Sir, what is this 9,000? This is nothing but dividends received. This is nothing but dividends received. Okay. Now you are saying that this dividend is intercompany dividend. This dividend is intercompany. So I will deduct it. Okay. Less elimination of intercompany dividend. Intercompany dividend. So how much is that? Well, that is 9,000. पूरा का पूरा dividend था. It was entirely dividend. So eliminate intercompany. अरे, but if you eliminate intercompany dividend, it means post profit तो था. Why this dividend came? When we took it as distributed. But now if you take it as elimination this side, you will also have to eliminate the dividend that was distributed from the post reserves. No, you cannot say I will eliminate the dividend on one side and keep it as a distribution in the profits of the subsidiary. ऐसा नहीं कर सकते. You cannot do that. If you eliminate here, you will also eliminate it in the consolidated books of the subsidiary. You will also eliminate it there. Keep it here, keep it there. That is, keep it in working note 1, keep it also in working note 4. If you remove it from working note 1, you also remove it from working note 4. Yahan pe I have removed it. So therefore, I have not kept it in working note 4 also. Add. Now what you will do, add share in post acquisition profits. Post acquisition profits, wo kitna tha? That is also going to be equal to 9,000. That is also, because post profit is 10,000 into 90%. 10,000 into 90%. So 10,000 into 90% gives you 9,000. Now what you have saying, sir, I got dividend, I eliminated the dividend, but now I will be entitled to a share in the post acquisition profits. I will be entitled to a share in the post acquisition profits, and therefore it is rightly said that it comes to 9,000. This adjustment is happening without us looking at it. Okay, when I take it as 10,000 minus 10,000. Distribution of dividend, this becoming nil, going to parent and NCI. This P getting 0 is nothing but elimination of 9,000 as dividend and share in post acquisition profits. So it doesn't matter for post acquisition dividends. You can either do it this way or you can do it the usual way, that is adjusting the post acquisition reserves for dividend and then doing the split between parent and NCI. It will absolutely give the same answer. It will accurately give the same answer. कोई फर्क नहीं पड़ेगा आपको. It will not make any change to your figures. Okay. So pre-acquisition dividends, we have a dividend adjustment entry, consolidated P&L account debit to goodwill, or what you call as to cost of control account. Okay. वो एडजस्टमेंट एंट्री है जो अपने को करना पड़े. इफ इट इज आउट ऑफ पोस्ट एक्विजिशन, नो एडिशनल एडजस्टमेंट इज needed. No additional adjustment is needed. So with this background, anybody has any doubts so far? Anybody has any doubts, any difficulties, any problems so far? Yes. Any doubts? Aditya, is it clear? Shimona, is it clear? Shivashankari is not there, I think. Okay, so I hope it is clear. Okay, okay. I hope that this part is clear. Okay, so now coming to your theory, we have done parallel subsidiaries. Our last was intercompany eliminations, number 7. So we now move on to number 8. Dividend adjustments. Very important from examination perspective. Very important from examination perspective. If dividend is paid by the subsidiary, it should be analyzed whether it is paid out of pre or post profits. If nothing is given, comma, it is always assumed. काम आसान करने का मतलब take it to be out of post acquisition dividends. It is always assumed that dividends are paid out of post acquisition profits, unless profits are insufficient. Unless profits are insufficient. Okay, so I have dividend adjustment, paid out of pre-acquisition profits. Deduct dividend from pre-P&L in working note 4. So it will look something like this. This is your P&L. You do the analysis as pre and post. So it starts with this minus dividends. Okay. So this is what you are going to do. Post will remain as it is. And then the second thing that you are going to do is, after this, you will be required to pass an additional adjustment entry. Additional adjustment entry. Entry will be consolidated P&L debit to COC or Goodwill, as many of you rightly said. Parents share in pre-acquisition dividend. Parents share in pre-acquisition dividend. Okay. If it is out of post, paid out of pre-acquisition, if it is paid out of post-acquisition profits, then in that case, first one, deduct dividend from post P&L in working note 4. So it looks something like this. Now this is from post. So first one is pre, second one will be post, less dividend. Okay. Okay. So this completes the adjustment for dividend. Do you need any additional adjusting entry? No. No additional adjustment entry required. No additional adjustment entry required. Okay, so if it is pre-acquisition, you need the additional adjustment entry. This is important for us to remember. Okay, very important. I have also explained why you are going to deduct it. Why you are going to deduct it. Okay. So dividend adjustment. Extremely important. Extremely important. Okay. Yes. Any doubt so far? Any doubts or difficulties? Anyone? Yes, please help me. Okay, just note this down. I'll be back in a minute. Okay. Okay. So I hope that you have written down this adjustment about dividends. Now we will quickly pick up the next one, a small adjustment. So this was adjustment number 8. Adjustment number 9. Adjustment number 9. In all the questions that we have done so far, these were acquisitions happening at the beginning of the year, acquisitions that happened right at the beginning of the year. So when these acquisitions happen right at the beginning of the year, it is quite simple. Okay. But is it necessary for acquisitions to happen right at the beginning? Answer is no, it's not. It can happen at any point of time. वो साल के बीचों बीच हो सकता है. It can happen in the very middle of the year. How are we going to do at that case? Well, you cannot directly do it as pre and post. You will have to make certain assumptions like profits are accruing evenly, and whatever is the profit of the year when the acquisition happened, proportionately on a pro rata basis adjusted for time, calculate the profits and then allocate it to the respective sections, whether it is pre or whether it is post, and then you solve accordingly. Okay. So normally we will prepare a statement or what is known as a P&L appropriation account, where you are having opening profits, add profits earned during the period. This profits earned during the period, you will have to distribute it, prorate it. Then dividends, either pre or post, the question will specify. And finally, you are having the closing balance. Okay. So 9th adjustment will be acquisition date different from opening balance sheet date. Acquisition date different from opening balance sheet date. For such cases, comma, prepare a working in order to calculate PAT, profit after tax. Okay. In order to calculate profits after the opening balance sheet date. Profits can be assumed to accrue uniformly throughout the year. And hence, those profits which are calculated will be proportionately split between pre and post acquisition periods. Okay, so that is the adjustment. So basically you will prepare a statement, find out the profit earned during the year, attribute part of those profits to the pre-period, part of those profits to the post-period. Opening balance in P&L will in any case always be pre. Opening balance in any case will always be pre. Okay, so we will just prepare this working. So if you have written this down, just prepare this working. Calculation of profits. Okay, so opening balance, this is always going to be pre. Add profits. This profits will come as a balancing figure, and these profits will be a proportionate distribution. Less dividends. This will be given whether it is pre or post. You cannot distribute the dividends on a proportionate basis. Dividend is declared at a point in time. So therefore, dividend will either be entirely pre or entirely post, unless the profits are insufficient. For one category, balance will go to the other category. So as per data given. Okay. So this comes to closing balance. Okay. So that completes our dividend adjustment as well as acquisition date different from the opening balance sheet date. Okay. So these are two small adjustments. Dividend is more important. Okay. It is frequently asked in the exam. So kabhi bhi aa sakta hai wo. Okay. So with that background, I think we will proceed to one of the questions that are there. Format and everything is ready, so I don't think I will need a lot of time from your side. Okay. So we will quickly come to question number 8. I will be doing question number 8 with you. It's an important one. It has also come in your examination. Okay, it has also come in your exam. So I would be happy if you do it sincerely. Okay, so I don't know how many people are watching. Okay, I'm not sure if there is anyone who is still. Hope you have written the notes also. Okay, so now coming to question number 8. Coming to question number 8, mark it as important. It has come in the exam also, a similar question. Okay, so Ram Limited acquires 60% ordinary shares of 100 each of Christian Limited on 1st October 20x1. So this is during the year. Okay. On 31st March 20x2, the summarized balance sheets are given. Land, building, plant, machinery, investment in Christian Limited, inventory, trade receivables, cash. Then you have, then you are having your equity capital, reserves, retained earnings, financial liabilities, में bank overdraft and trade payables. The retained earnings of Christian Limited showed a credit balance of 60,000. Okay. On which date? On 1st April 20x1. Is this the date of acquisition? Answer is no. Is it after the date of acquisition? No. Is it before the date of acquisition? Yes. So can I say that this entire 60,000 is a pre-balance? Yes, this entire 60,000 is a pre-balance. And reading further, out of which a dividend of 10% was paid on 1st November. So out of this 60,000 dividend is paid. This 60 happens to be pre-acquisition. So can I say that this dividend is also out of pre-acquisition profits? So can I call it as pre-acquisition dividends? Yes. So do I have to do the adjusting entry? Definitely. So I will do the adjusting entry. Ram has credited the dividend to its retained earnings. Nothing wrong in this. Okay. This would be a problem under AS 13 because in AS 13, dividends prior to acquisition, if you receive, it must be adjusted against the cost of the investment. In this case, Ind AS says that dividend should always go to P&L. Don't look at the source of those dividends. So for the purpose of 109 in the standalone, Ram Limited has given correct treatment, but we will take it as pre-acquisition and make the necessary adjustments while consolidating. Fair value of plant and machinery as on 1st October was 4 lakhs. Rate of depreciation on plant and machinery is 10%. So we are having a fair value adjustment also. जो अपने को करना है. Okay. We are also given rate of depreciation. So we will be having the post acquisition adjustment also. Following are the increases on comparison of fair value. Okay. So this is the increase. This is not fair value. What is the trade payable? That much it has increased by. Okay, it is not saying that trade payable is 20,000. It is saying trade payable has increased by 20,000. Land and building increased by 2 lakhs. Inventory has increased by 30,000. Okay, so these are increases on comparison of fair value as per respective Ind AS with the book value, which are to be considered. So ये fair value नहीं है. They have compared the fair value with the book value. This is the difference, and they are saying that the book value has to be increased by this amount. The book value has to be increased by this amount. Okay. It may be assumed that inventory is still unsold on the balance sheet date. So post acquisition adjustment, inventory is unsold. Do I need to pass the reversal entry of the profit? Answer is no. It is unsold. The trade payables are also not yet settled. If they were to be settled, I would have to pass the reversal entry. If they are not, I will not pass any entry. Also assume that other reserves as on 31st March X2 are the same as it was on 1st April 20x1. So prepare a consolidated balance sheet as on 31st March 20x2. So we will quickly proceed with the question. Consolidated balance sheet is ready. So first step, write down the figures as it is from the question. Okay, just a minute. Write down the figures as it is. So you are having your land and buildings, plant and machinery, etc. So just copy those figures. Don't make any adjustments. Okay. So this is 3 lakh, 480, 360, 270. 3 lakhs, 480, 3 lakh 60,000, 2 lakh 70,000. So this total comes to 7 lakh 80,000 and 6 lakh 30,000. Okay. Next one, I have inventory 2 lakh 40, 72, 800 and 119, 600, 80,000, 929 and 16. So all these items I have not considered 8 lakhs as yet, but remaining I have considered. Okay. So all these items are taken. So inventories 2 lakh 40,000, 72, 800. Then I have trade receivables 1 lakh 19,600 and 80,000. Then I am having cash and cash equivalents 29,000 and 16,000. Trade payables, I have it below. Bank overdraft and trade payables 1 lakh 60, 94, 200 and 34, 800. So 94, 200 and 34, 800. And this is bank overdraft 1 lakh 60,000. Okay. So recorded all the items. Now what is left is equity capital of the parent. So 10 lakhs is going to come as it is. Okay. In the note number 2. Shares are of rupees 100 each. Okay. So 10 lakh means 10,000. So 10,000 equity shares of rupees 100 each fully paid. Of rupees 100 each fully paid. So that is 10 lakhs. That is 10 lakhs. Okay. So this is your equity share capital. Coming to your reserves, we have other reserves and retained earnings. So consolidated other equity will flow from there. So other reserves, working note number 1, you have standalone RAM Limited. Standalone RAM Limited. What are the figures? Sir, it is 6 lakhs and 1 lakh 14,400. Other reserves is 6 lakhs and this is 1 lakh 14,400. Okay. What is your holding? What is your holding percentage? RAM Limited acquired 60%. So my share is 60% and NCI is going to be 40%. What method are we going to use? Proportionate share of net assets. Proportionate share of net assets. Well, this is ideally what I have assumed. This is what is ideally assumed. Okay, unless they give the fair value. वो दिया भी नहीं है, so I have to do it in this way. Okay, so coming to cost of control account. First thing is eliminate the investment in Krishan Limited 8 lakhs to investment in Krishan Limited. This is 8 lakhs. Okay, so this is eliminated. Now I will eliminate it against what? I will eliminate it first of all against the equity capital. Okay, so by equity share capital 4 lakhs into 60%. 4 lakhs into 60%. So that gives you 2,40,000. That gives you 2,40,000. And here by equity share capital, 4 lakhs into 40%. So that gives you 1,60,000. That gives you 1,60,000. So I have done the equity capital. We then move on to analysis of reserves. So 1, 2, 3, 4. Other reserves. Other reserves is having a balance of 2 lakhs as per the question. Yes, it is having a balance of 2 lakhs. Somewhere in the question they have said take it to be the same as it was. Other reserves on March X2 is the same as 1st April. Even if this information was not given, it would be prudent to assume. कोई और assumption तो हम कर नहीं सकते that this much is transferred from the P&L, etc., etc. So this is a very prudent assumption. Even if that information was not given, we would still assume the same thing. Okay, so 2 lakhs, I will be dividing it into pre and post. Okay, this was there right from the beginning, they have said. So pre is up to 1st October 20x1, and then I have post. What is my post period? 1st October 20x1 to 31st March 20x2. Okay, so this is entirely pre. Post, nothing is there. So this one, let us further split it up. Into RAM Limited and NCI. RAM Limited is holding 60%, NCI is holding 40%. So 1,20,000 and 80,000. Post it in the appropriate accounts. This goes to COC account, working note 2. This goes to NCI account, working note 3. So go to your COC account, by pre other reserves. Working note 4, 1,20,000. NCI by pre other reserves. Again, working note 4. This is 80,000. Okay. Next one is retained earnings. And now the thing arises with retained earnings. Okay. They have given the balance as on 1st April 20x1. The present balance is 1,64,000. Okay. So now coming to retained earnings, balance on 31st March 20x2, it is 1,64,000. Acquisition, is it happening at the beginning or is it happening in the middle? Answer is it is happening in the middle. So we will have to calculate PAT for the current year. So calculation of PAT for 20x1 x2. Okay. So how do I calculate PAT? Well, I start with opening balance. Your opening balance is given to be 60,000. This is on 1st April 20x1. Add profits for 20x1 x2 less dividends. Dividends declared. How much is declared? This is declared on 1st November 20x1. 1st November. Okay. November 20x1. Dividends kitna hai? Well, my dividend is 10% on 1st November. It is always 10% when they say it is always on the share capital. Okay. So share capital is 4 lakhs. So 10% of 4 lakhs is 40,000. Okay. So 4 lakhs into 10%. So that gives you 40,000. And with that, we are left with the closing balance as on 31st March 20x2. balance on 31st March 20x2, 1,64,000. Now, what all data is given? This is definitely going to be pre, because you have acquired on 1st October, but it is on 1st of April. Dividend is out of pre, so no doubt about this. However, the balancing figure is going to be 1,64,000 plus 40 minus 60. So this gives you 1,44,000. This is the profit after tax which the company has earned. This is during the year. You have acquired on 1st October. That means 6 months is pre, 6 months is post. Okay. So pre 6 months, post 6 months. Okay. So this is your adjustment. This is your adjustment. Okay. Now, the dividends are pre. How do I know that? From the question. They are saying that showed a credit balance out of which a dividend was paid on 1st November. And 1st November means acquisition has happened on 1st October. So who will receive the dividend? It is Ram Limited who is going to receive the dividend. Okay, because it owns the shares on 1st November. All right. So with this background, let us now start to do the working for retained earnings. Okay. So I am having retained earnings of the subsidiary. Retained earnings of Christian Limited. How much is that? So that is 1,64,000. This figure also is considered now. So all figures are considered. All right. So now we will have to split this up. Now we will have to split this up. Okay. So 1 second, please. All right. So this split is pre, that is up to 1st October 20x1, and post, that is 1st October 20x1 till 31st March 20x2. So how do I get this? Well, the first thing is balance on 1st April 20x1. Is this pre? Yes, this is entirely pre, 60,000. Then 1st October till 30th September, 6 months profit. 6 months profit. Which 6 months? 1st April 20x1 till 30th September 20x1. So that comes to how much? You have this 1,44,000. So pre is 6 month period. So 72,000. How did I get this 72,000? 1,44,000 into 6 by 12. 1,44,000 into 6 by 12. And then out of this, dividend is being declared. Dividend of 40,000. This data is given to you. This data is given to you. So it leaves you with the profits to be allocated as 60 plus 72 minus 40, giving you 92,000. Giving you 92,000. Post will be only the 6 month profit. Okay, post figure will be the 6 month profit. Okay, so 6 month profit, which is 72,000. Which 6 months? 1st October 20x1 to 31st March 20x2. And this 72,000 is what you will ultimately distribute. Okay. Now, before the distribution, we will have to check whether there are any adjustments. Fortunately or unfortunately, Bolo, there are some adjustments. So what are the adjustments now? There is a fair value adjustment. Initial as well as subsequent. So both the fair value adjustments are there. And after that, there is a dividend adjustment. Okay, so first we will do the dividend adjustment before we forget. So pre-acquisition dividend is there. So you will have to pass the adjusting entry. So consolidated P&L account debit. This is going to be your share to COC account. Your share. So total dividend is 40,000, out of which parent's share is 60%. So this comes to 24,000. This comes to 24,000. Okay. Where will this go? Consolidated P&L working note 1, COC account working note 2. COC account working note 2. Then we give the effects in the appropriate places. So go to consolidated P&L working note 1 less pre-acquisition dividends. Pre-acquisition dividends. How much is that? Sir, that is 24,000. That is 24,000. Go to cost of control account by pre-acquisition dividends. Pre-acquisition dividends working note 5. Working note 5, 24,000. 24,000. So that concludes our dividend adjustment. Next one is the fair value adjustment. Now this is something we are all fairly comfortable with. Okay, so first one, we start with the initial adjustment. Initial adjustment. Now initial adjustments means on the date of acquisition, what is the fair value? Fair value on the date of acquisition is 4 lakhs for plant and machinery. Okay, plant and machinery was 4 lakhs. But this is on which date, sir? This is on 1st October 20x1. And therefore, can I directly compare this plant and equipment of 2,70,000? Can I directly compare it with 4 lakhs? Answer is no, you cannot, because 2,70,000 is the value on 31st March 20x2, whereas 4 lakhs is the value on 1st October 20x1. So I cannot compare that. That means I need to get the value on 30th September or 1st October. Which value? Carrying amount. Can I get that? Yes, I can definitely get that because the rate is given. Okay, because the rate is given. So calculation of carrying amount. This is PPE. First one. Okay, of not PPE. I will use plant and machinery. Okay. Plant and machinery. Okay, so calculation of carrying amount. How do I get this? Well, I start with opening WDV. This is on 1st April 20x1 less depreciation. So that gives you closing WDV. Okay, that gives you closing WDV. This closing WDV is 2,70,000. This is given to you. So if opening WDV is 100, depreciation is 10, this will be 90. So now all you need to do is cross multiply. Okay, all you need to do is cross multiply. You will get opening WDV as 3 lakhs. You will get opening WDV as 3 lakhs. Now with this opening WDV, I can charge 6 months depreciation. So calculation of carrying amount on 1st October 20x1. That is what we are interested in. Okay. So now I got that opening WDV. Now we proceed to calculate the depreciation. Okay. Carrying amount on 1420x1. This is 3 lakhs. Less depreciation for 6 months. 30,000 was for the full year. So 6 months means 6 by 12. So this is 15,000. So your carrying amount is 2,85,000. This is carrying amount on 11020x1. What is the fair value on 11020x1? Sir, the fair value is 4 lakhs. The fair value. Therefore, increase in plant and machinery is how much? Well, this increase is 1,15,000. This increase is 1,15,000. For other items, directly the increase is given. Therefore, increase in other items of PPE and inventory is directly given. Therefore, journal entry is like this. Plant and machinery debit. Plant and machinery debit 1,15,000. Then you look at the question. Land and buildings went up by 2 lakhs. Inventories went up by 30,000. Land and building went up by 2 lakhs. Inventory went up by 30,000. Inventory went up by 30,000. 2. Trade payables also increased. Trade payables also increased by 20,000. So the difference ultimately goes to pre-retained earnings. How much is that? Well, this pre-retained earnings is going to be 1,15,000 plus 2 lakh plus 30,000 minus 20,000. So this gives you 3,25,000. This gives you 3,25,000. Where do these items go? All these items go in note number 1, whereas this item goes in working note 4. So go to note number 1. Go to note number 1. In note number 1, you will go to plant and land and building and add there 2 lakhs. Go to plant and machinery and add 1,15,000. Go to inventory and add 30,000. Go to trade payables and add 20,000. Okay, so these are the adjustment effects. And the second effect will be given in the pre-retained earnings. Second effect will be given in the pre-retained earnings as add fair value adjustment initial. How much is this? 3,25,000. 3,25,000. Then will there be a subsequent adjustment? Will there be a subsequent adjustment? Yes. Additional depreciation. Okay. So B will be subsequent adjustments. Subsequent adjustments. Now these subsequent adjustments will be on account of additional depreciation. Okay, so depreciation based on fair value kitna hota? How much would it be? Well, it would be 4 lakhs into 10% into 6 by 12. So that comes to how much? 20,000. Which 6 by 12? Post acquisition period, 1st October X1 to 31st March X2. Okay, then I am having depreciation based on book value. So this will be 3 lakhs into 10% into 6 by 12. So this is again 11020x1 to 31st March 20x2. So this comes to 15,000. So the additional depreciation that is there is 5,000. Now, many of you may also make a mistake and say that this has to be 2,85,000. Some of you may say this has to be 2,85,000, in which case your answers will change. It cannot be 2,85,000 because depreciation is charged on opening balances. You don't calculate, it is not like compound interest where for every month interest you will go on adding the interest to the principal. Depreciation does not work like that. Depreciation is on the opening balance of the particular year, and therefore it is 15,000 for the first 6 months. It will be 15 for the next 6 months also. It is not on a 6 monthly rest. It is an annual charge that is given. Okay, so 2,85,000 is what is going to be your, this cannot be your answer. It will be 3 lakhs into 10% into 6 by 12. Okay, so what will be the entry for this? Entry will be post retained earnings, post retained earnings account debit to plant and machinery, to plant and machinery. How much is that, sir? That is 5,000. That is 5,000. Where will these items go? These items will go working note 4, and this will go in note number 1. So go to note number 1. You are having plant and machinery. There you deduct 5,000. There you deduct 5,000. Okay. There you deduct 5,000. Go to working note number 4, and in working note number 4 you will be deducting 5,000. Okay, so less additional depreciation on plant and machinery. This is going to be 5,000. This is going to be 5,000. And that concludes. I'm not given data for additional depreciation of other items. Okay. So rate of depreciation of land and building is not given. Hence, assumed that fair value movement is solely attributable to land. Building component has not increased, solely attributable to land, and hence no subsequent adjustment, and hence no subsequent adjustments. Okay, so that concludes our discussion on this problem. Then they have told that these remain unsold, that is inventory, and the payables are also not paid. If they were to be paid, it would be trade payables to post P&L. If inventory had to be sold, it would be post P&L account debit to inventory. Okay, for the amounts that you had increased the value by. Okay, so no adjustment. So now what we do? Well, we total this up, 4,17,000, and this 4,17,000 we will be splitting it up between Ram Limited and NCI, and this 72 minus 5, 67,000 we will be splitting it up between Ram Limited and NCI. So how much would that come? At 60%, this would be 2,50,200. Okay, just to check. 4,17,000 into 60%. Yes, and this is 1,66,800. Then 60% means this is 40,200, and this is going to be 26,800. So this goes to working note 2 COC account. This goes to working note 3. This goes to working note 1, and this goes to working note 3. Okay, so that concludes the adjustments. Give the effects quickly. So by post sorry, both are there, no? So by pre-retained earnings, this is working note 4. That comes to how much? 1,66,800. And then I'm also having by post retained earnings, working note 4. This is 26,800. My writing is a little gone bad. Then cost of control, only pre-retained earnings will come. So by pre-retained earnings, this is working note 4. That comes to 2,50,200. Okay. And post-retained earnings are taken here. So here I will add the post-retained earnings. Add post-retained earnings of Christian Limited. Okay, so that is 40,200. From where this is working note 4, this is working note 5. Total up all the items. So NCI account, you total, you should be getting how much? You should be getting 433,600. 433,600. 4,33,600 to balance carried down. Then you move on to the COC account. Total the COC account, that gives you 8 lakhs. 8 lakhs. So 8 lakhs minus the credits, that leaves you with 1,65,800. This is your goodwill. This is your goodwill. Okay. So this goodwill will go to the balance sheet. Then total up the reserves and the retained earnings. This is 6 lakhs and this comes to 1,30,600. Take these reserves to note number 3. Retained earnings, and the other one is other reserves. Okay, so retained earnings, working note 1, other reserves also working note 1, 1,30,600, and this was 6 lakhs. So total is 7,30,600. Then all that you need to do is total up these items. So this note number 1 totals come to 3,360, 660, 8,60,000, 480, 270. So 426, 750 plus 120, 110. So this again comes to 8,60,000. So total is 8. So 17,20,000. 2,40,000 plus 72, so 1,02,000. So this comes to 3,42,800. This comes to 1,99,600. 29 plus 16 comes to 45,000. 94 plus 34,800 plus 20,000. This gives you 1,49,000. And bank overdraft comes at 1,60,000. Okay. So if you post all these items in the consolidated balance sheet, I already will post 2 items, that is working note 2, what is my goodwill figure, which is from working note 2. This is 1,65,800, and NCI is working note 3, that was 433,600. This was 165,800 and 433,600. Remaining all assets and liabilities, if you post along with equity, capital, etc., your balance sheet should tally, and it should tally at 24,73,200. Okay, this is the figure of the tallied balance sheet. Kuch nahi, all that you have to do is note number 1, whatever we have recorded, just record it on the balance sheet face, and that should help you get a tallied balance sheet. Okay, so with that we conclude this question number 8. right? It's a fairly simple question, nothing wrong, but it's important. Similarly, once you do this, I will suggest you try this question number 9 for practice. It is same like question number 8. Only thing is figures have changed. NCI won't be there because 100% capital is owned by 100%, XYZ is a 100% subsidiary. Okay. So with that, we conclude our discussion for today. We have now ended the discussions on dividend. We have completed the discussions on fair value adjustments. We have completed quite a number of discussions on the adjustments related to consolidation. We now will be starting with stake sale, stake purchase, and a chain holding, and last one is joint arrangements. These 4 topics we will be doing it in the next session. Okay, I'll be a little bit fast for chain holdings because just one concept is there, and likewise I'll be fast for additional stake sale and stake purchase because they're quite simple. Okay, so with that we end our discussion today. We will then meet on Tuesday. So until then, stay safe, revise whatever is done, come out with your doubts, and we will meet on Tuesday. Okay, so thank you everyone. Thank you. Okay, so we close for the day. Yes, just a second.